Daily stock market update on the 18th of November before US Open. US stock futures were holding up. Just so you understand, if futures in the S&P contracts or the NASDAQ are up before market open, because the futures market trades 24/6, pretty much 5.5 days of the week and 24 hours a day, whereas the stock market doesn't, of course, then that can give an indication of which way the stock market's likely to open. So if these were up, it can give you an idea they're up. Before you come up with any complicated trading strategy, don't bother. You're not a quant hedge fund. It's not going to happen. Nvidia's earnings still the dominant factor. The other factors in play: September payroll figures, in other words, employment numbers, how many people are in work in September in the US, who cares? We're in November, going into December, looking forward. So there's going to be all this extra data, but it's irrelevant. Most things that come out each week in the markets, particularly economic data, are completely irrelevant. They're very good for keeping economists in a job. Alphabet in pre-market trading was up 5%. This is because Berkshire Hathaway bought $4.9 billion. Now, what's interesting is they've already bought it. It's not because they're in the process of buying it that they're bidding up the price. It's the fact that they have already bought it that has led other people to suddenly discover Alphabet or give extra credence to the activities of Berkshire Hathaway. Is it good? Yes, I own Alphabet as well. I've held it a hell of a lot longer than Berkshire Hathaway have. Will I continue holding it? Yes. Are there likely to be wobbles? Well, Sundar Pichai, the CEO, was on the BBC saying he fully expects they themselves could fall if there is volatility in AI stocks. Well, of course they could. He doesn't need to be a stock investor to know that his stock is correlated to other technology companies and even more broadly to the market. So no great insight from him there. What was interesting is that the market short term is seeing this as positive. They're soon going to forget that Berkshire Hathaway have bought this, and it usually takes about 3 days to forget most things. That's why I don't like good news coming out on a Friday, because by Monday they've forgotten about it. I don't mind bad news coming out on a Friday, because by Monday they've forgotten about it. So Alphabet, good news in the short term. But if that's your reason for buying Alphabet, you've got a problem, because then your hypothesis is that I will buy whatever new purchases Berkshire Hathaway makes. Have you tested that hypothesis? It might well be good, but if you haven't, and your way of picking stocks is through snippets of information here and there, it's not a very, well, to put it politely, scientific approach. I won't put it impolitely. Fed officials, the Federal Reserve, the US central bank, continue to push back on expectations of December rate cuts. The market is expecting about a 40% chance of a rate cut in December. As I've said before, that is good news, actually, because the longer we drag out the expectations of more money coming into the market through lower interest rates, the longer the stock market will sniff around higher and higher. The moment the stock market thinks interest rates have bottomed and are not going to go any lower, as they did in 2022, expect the market to come off 25% over the subsequent 12 months. So this is good. If they do cut them in December, then January might be a negative month. Bitcoin falling back again, trading, last I saw, $93,000, so below 100,000. I wouldn't be looking to buy into it unless it drops significantly more. You see, the whole issue with anything, whether it's a Microsoft or Costco, Walmart, Rolls-Royce, whatever it is if you like it for the longer term, then what's the price at which you'd buy more of it? If you buy it off only a 1% drop, you're going to end up with an over-concentrated position, because 1% drops happen all the time. But if you wait to buy more of it, if it drops 90%, you might end up with either a permanent loss or have waited too long, because those drops don't happen. So what's the number? And every stock will have their individual number. If you take Meta in 2022, it dropped 75%. So Meta, unlike a Microsoft, which similarly in that year on an atypical dropped 30%. With Microsoft, you probably want to start buying more if it drops 20-25%, but with Meta, you probably don't want to be buying more unless it drops 50-60%. What's the case with Bitcoin? I'd probably say off the top of my head, off its highs, a 50% drop before I'd look to buy more. Anything before that, and I'll probably end up with an expensive, overpriced, concentrated position. Okay, UK assets still focus very much on the 26th of November budget. Now, that means volatility. That means I don't probably want to take any big moves before then. I shouldn't expect there'll be more surprises regarding the budget other than the two main things: fiscal tightening, how bad will it be, i.e. higher taxes, and secondly, and that'll really affect the gilt market, and that means what foreign institutional buyers are willing to charge the British government for its debt. That's really the important point about the budget. It's not even how it's going to impact British consumers and investors. It's what's it going to do to interest rates. Ironically, interest rates are basically controlled by two main institutions, the Bank of England and the international bond market. So a bunch of foreigners, essentially. I don't mean there's a bunch of foreigners on the Bank of England. There are people of foreign origin. That's neither here nor there. But the institutional bond market, it's not run by the Brits. And that's the people who set the interest rates that the government pays on its credit card for borrowing money to pay for things that it can't afford, like roads, for instance. Now, that interest rate will go up if taxes are not raised. Why? Because those bondholders will say, well, we think that the British government's a bad risk. They're not raising enough taxes, therefore they're not being responsible. Now, you might disagree with the international bond market, but that's their view at the moment, and they can have any view they wish because they've got the money. The old saying, the person with the gold gets to make the golden rules. Now, if interest rates drop, cost of borrowing decreases, that's if taxes go up. So guess what? Taxes go up, you'd think that'd be a squeeze on the economy, but interest rates go down to equalize it. In other words, net GDP, UK growth, it should be pretty flat. Whatever the Chancellor tightens on the tax side will probably be loosened, or is expected to be loosened, by the monetary or interest rate side. I know. All that hard work, all those clever people, and the net effect is nothing. Just a redistribution of money from one category of individuals in society to another. Now, oil, well, Russia's Novorossiysk port has resumed, so oil isn't going any higher, which is fine. Despite all the conflict and war, oil prices are still well below $80, so nothing to worry about. Okay. NVIDIA results again. Now, UK single stock moves. WPP is the biggest mover up on the UK markets. That's because there is some interest, takeover speculation from Havas. Havas is, well, it's a company my sister works at. That's all I know. I would not ask her for any additional information for obvious reasons. 91, the fund manager, well, they've missed profit estimates despite higher assets under management. Why would that happen? Well, as a fund manager, the problem is, and many of you will have money with fund managers like 91 or Vanguard, they're very good at marketing. They need to market because they earn fees based on the assets under management, but they're not very good at making profits for themselves because there's pressure for them to cut fees because people like me point out that they're not very good at delivering returns which can beat just a simple index tracker. So they keep cutting fees and marketing like crazy on the basis that if they sell more of their funds at a lower price, net, the effect will be that they'll keep their profitability. It's not working for them at the moment. So sadly for them. Budget-related companies which are moving up and down, Foxtons, Taylor Wimpey, Domino's, Grafton. If you want to gamble around the budget, I suggest you go to Ladbrokes and not the stock market. Okay? If you make any winnings, take them and go to Vegas instead. The US markets, well, there's some data that the private sector is not booming as much as might be thought. This is where the talk of interest rates cuts come in. Like I've said before, the problem is stock market at all-time highs, asset price inflation suggests that interest rates ought not to be cut, because when interest rates are cut, tech companies who tend to borrow money, even though they're cash flow positive, but they can get cheap money and they'll get it even cheaper, will fuel that stock market boom. So if interest rates are indeed cut, the fact that Apple can borrow money at whatever it is, 1.25%, that's free money. Even if it's got $1 trillion sitting in its bank, that's worth having locked in. I mean, imagine I said to you, you can have a mortgage where the interest rate is slightly over 1%, your cost of capital being so low, you have a pretty good idea that your return on that capital will be greater than the cost of capital. Boom, you've got a money-making machine. And that's why the big tech companies are going to be buoyant and doing well under the shadow of lower interest rates. So that's good. A full cut is not priced in until March, according to the market. So we might be waiting till March, which is good news. The longer this carrot is put in front of the donkey's nose, the longer the donkey keeps going up, and the markets keep going higher. So no worries there. What else have we got? Well, cryptos, I've had gold, $4,000 an ounce, holding firm, macro uncertainty, momentum. I think people are too busy looking at crypto, oil, and stocks, and this whole NVIDIA thing. Alphabet rose 5% because of that stake by Berkshire Hathaway. Now, are these stocks expensive? It's very easy to talk narratives. Alphabet trades at roughly 25 times forward earnings. What does that mean? That means for every dollar of future profits, you're paying $25 when you buy an Alphabet stock. Put another way, imagine you had a property and it generates $1 in rent a year. You're willing to pay $25 for that property. You might say, well, that's crazy. Why would I pay $25 for something that's only going to give me rent at $1? There's a variety of reasons, one of which is you might think you can sell it because all the other properties on the street are trading at $30 for a future dollar of profit. So you think, well, I'll just flip it and sell it at a higher price. But $25 or 25 earning multiple is cheap in several ways. How do you measure valuation? And valuation isn't the only thing that moves stock prices. The way you measure valuation for a company, one way is compare it to its peers. Well, it's cheap compared to other technology companies. You compare it to its own history. Well, it's cheap compared to what Alphabet generally invests at as well. And you can compare it in terms of absolute numbers, 25. Generally, such companies would trade at far higher multiples because future growth is priced in. You might buy a property for $1 rent a year because you know it's going to be $2 next year, $3 the year after, for instance. On all those bases, Alphabet is a good purchase, as I've said for a long time, which I happen to own as well. Okay, so that's where we are. There is signs of worry on the AI side, particularly with firms such as Oracle and CoreWeave. There is talk about credit default swaps, CDSs. Do you remember those? 2008 financial crisis. The market now knows to look at what price basically institutions are giving insurance to shareholders or people who lend money to these companies that they won't go bust. And if the insurance spikes, then somebody somewhere has a very good interest in making sure they know whether or not those companies are in trouble. So you go by those people and what they're willing to pay for insurance. For instance, if I was suddenly willing to pay 10 times more for my house insurance, fire insurance in my house, you might question, hang on, Alpesh, do you know something about the arsonists who've just moved into your street? Yeah, asymmetric information. It's the reason why we're always wary when you buy a secondhand car. What does the seller know that I don't know? Similarly with credit default swaps, all we're doing is we're saying, do they know something we don't know if they're willing to pay more for that insurance? So the worry is Oracle, CoreWeave, and a few other companies. There might be some issues there. Could be premature on that. Okay, now Morgan Stanley think the S&P 500 will rally 16% next year. Fourth year of rallies. Now, they believe this is the case based on profits are expected to grow 17%. And next year, in S&P 500 stocks on average and 12% the year after. Pricing power is one reason. These companies, some of them are monopolies. AI, of course, is another, leading to efficiencies. So if he's right, we're going to have a good year. The problem is going to be being able to avoid panic and boredom. The boredom that comes from, well, wait a minute, everything seems to be high. Why aren't I making lots of money? And the panic, which will come from the dips that happen in between. People do not realize that even in a year like 2022, when Meta dropped 75%, the fact that it rose 300% the year after, they forget. And you need to know what the volatilities and drawdowns of individual stocks are that you hold so that you can decide whether they are one where you'd want to buy if they fall 20%, yes, in the case of Microsoft, or whether you'd want to sell if they drop, say, 20-25%, because they might drop significantly more as they historically have, and you'll buy back cheaper when they're down 70%. Or do you just patiently want to buy and hold and do neither of those other two things, which could wrong foot you and wrong time you in any event? That's the daily update for today, the 18th of November. Please put in the comments that you want to see more of these. Please save them, because it then leads to greater views. If I get more than 5,000 views a day, I will keep doing them. The best way to trigger that is if you save them, like them, repost them, follow my channel. All of those things make TikTok boost the algorithm and make sure that I keep doing them. So it's all up to you. If you keep wanting them, I will keep doing them. Thank you all very much.